So welcome, ladies and gentlemen. My name is Peter Yusuf, and together we'll be going through a presentation about the week ahead. Now, before we start, let me display the disclaimer and the risk warning, and I'll leave you a couple of seconds to go through it. So before we start, we are leaving behind us a week full of surprises which shook the markets, with the USD stabilizing somewhat after a heavy drop the week before in the FX world. The coming week is expected to be packed with financial releases, some of them being of high impact, that could move the markets once again. Now, releases such as China's industrial output for April on Monday, UK's employment data for March, and UK CPI rates for April on Tuesday and Wednesday, respectively, as well as the US weekly initial jobless claims figure on Thursday, should be kept under close watch amidst other financial data due out. The crown jewel, though, is expected on Friday, as the preliminary PMI readings for May of a number of countries and various sectors are to be released and could create increased volatility for a number of currencies as well as beyond the FX market. On the fundamentals, the pace of the US economic recovery, along with the inflationary pressures, which seem to be building up, the path of the pandemic in various countries, and monetary policy stance of various central banks could move the markets. Now, with no time to waste, we move to the US dollar. And this should be the USD index for our chart. Note that practically the index has rather stabilized in the past 2 weeks and is moving between a high level of 91.30, which is our R2, and the low level would be at around 90.25. That occurred practically, the stabilization occurred practically after breaking the downward trend line characterizing its movement throughout April. Now, important levels to keep an eye out would be to the downside, as we have mentioned, the 90.25, even lower the 89.65, and even lower than that, the 89.15. To the upside, I would highlight the 90.75, even higher the 91.30, which we have mentioned is the upper level or boundary, if you prefer, if it's past high dose movement, and even higher than that, the 91.80, which provided considerable resistance around mid-April. Now, moving to the fundamentals of the US dollar. The USD, as we have mentioned, was weakening as the week began, yet after the better than expected CPI rates for April, it gained some ground and seems about to end the week somewhat higher. In the grand scheme of things, it looks as if the greenback has temporarily hit the pause button on weakening. The better than expected CPI rates were proof of the inflationary pressures in the recovering US economy and are increasing the pressure on the Fed to act sooner rather than later. Now, the markets seem to have started to highlight the possibility of the Fed hiking earlier or start tapering its QE program in an effort to tighten its monetary policy. Yet for the time being, the US central bank seems to stick to its dovish script, at least for now, highlighting its tolerance towards higher than its target inflation rates. It's characteristic that St. Louis Fed President Bullard yesterday stated that monetary policy is in a good position and it does not want to shift policy in a crisis. On the fiscal front, we would note that Biden's efforts for his infrastructure plan are ongoing, and any news showing that Republicans and Democrats are nearing could provide support for the USD, as it would imply a considerable higher fiscal spending over the long term. On the international affairs, the US-China relationships are still tense, and any escalation could provide some safe haven inflows for the USD. Also, please note that the US yields retreated further as the 10-year yield dropped after hitting a 5-week high on Wednesday. And should the drop continue, it could have a bearish effect on the USD. As for financial releases, we note from the US on Monday the release of the New York Fed manufacturing for May. On Tuesday, the housing data for April. On Thursday, the weekly initial jobless claims figure, as well as the Philly Fed business index for May. And on Friday, the preliminary market PMI figures for May. Moving now to the pound. This would be cables for our chart. Note that also cable has stabilized albeit it maintained a stepped movement to the upwards. Note that early April, it was a sideways movement between the 1.3845 and the 1.37. At the latter half of the month of April, it moved a little bit higher, moving between the 1.3845 and the 1.3990. And for the past week, it has moved between the 1.3990 and the 1.4145. So we maintain a rather sideways bias for the pair to move between the prementioned boundaries. Important boundary levels to note would be to the upside, the 1.4145, which marks the top of the pair's price action for the past 1.5 months. Even higher, the 1.4275, and the highest level noted would be the 1.4390. To the downside, I would highlight the 1.3990, which also formed some resistance at around the 20th of April. Lower than that, there would be the 1.3845, which served as a support level in the prior sideways motion of the pair, and even lower, the 1.37. Moving to the pound's fundamentals. Now, the pound rose above 1.41 for the first time since February and the beginning of the week, with cable also being supported by USD weakness. It should be noted that an easing of market worries about voices for a second Scottish independence referendum after the local elections on the 6th of May also helped the pound to gain some ground, as the political uncertainties seemed to be removed. Further lockdown easing, an intense vaccination program, and BOE being more confident tended also to be included among the factors contributing to the pound's ascent. UK GDP rates outperformed market expectations, which was another positive for the GBP, yet the market's attention next week turns to fresh data. The coming week, we note the release of the UK employment data for March on Tuesday, and on Wednesday, the April's inflation measures. On Thursday, we get the UK CBI trends indicator for orders, while on Friday, we note the release of the preliminary UK PMI readings for April, with special weight being placed on the services sector. In the pound's fundamentals, we would highlight the UK government's worries for the spreading of the Indian stem of COVID-19, which could also increase the related market worries as the mutation seems to be highly transmittable. Should negative headlines multiply, we may see market worries intensifying, and they could weaken GBP. The main reason seems to rely on the idea that should the disease spread like wildfire once again, we may see the easing of lockdown measures in the UK being put in jeopardy, thus creating substantial worries for a slowdown in the UK's economic recovery and a return to normality. Moving now to JPY, and this would be USD JPY's 4-hour chart. Note that this pair as well has a sideways motion. We would dare to say that it remains between the 108.35 support line, and to the upside we note the 109.95. Now, important levels to keep an eye out would be to the downside the 109.25, which served as a support and the resistance level depending on the movement multiple occasions in the past 1.5 months. Lower than that, we note the 108.35. Note how the pair's price action actually tested the level at the 7th of May and later on at around the 12th of May. Even lower than that, we note the 107.65, which was tested extensively on the 27th of April. To the upside, we note the 109.95, tested on the 9th of April. And even higher, the 110.90, practically tested at the end of March. Higher than that, we note the 111.70. Moving to JPY's fundamentals. Now, JPY seems to have lost ground, which was gained the week before and is about to end the week low against the USD. Japanese fundamentals tend to highlight the efforts of the Japanese government to intensify its vaccination program, as it is behind compared to other developed countries. It's characteristic that Japan's cabinet decided to use 512 billion yen, which are currently in the budget reserved to secure coronavirus vaccines in order to contain the spread of COVID-19 infections. It should be noted that Japan's daily new cases number is still at very high levels, as the country is struggling with the fourth wave of the pandemic. Now, the criticality of the situation is even more intense as the country is about to host the Olympic Games in the coming summer. We continue to expect that safe haven flows and fundamentals, not only in Japan but also internationally, are to be the main drivers for JPY. Nevertheless, we must also note that we are about to get a high number of financial releases from Japan next week. As for financial data, we note on Monday the corporate goods price growth rate for April, and on Tuesday the preliminary GDP rates for Q1. On Thursday, we get the machinery orders growth rates for March, the trade data for April, and another highlight would be on Friday, the CPI rates for April, along with the preliminary Jibun Bank manufacturing PMI for April. Now moving to the euro and euro USDs for our chart. Once again, this pair moves in a sideways motion between the 1.1990 and the 1.2175. Important levels to note would be to the downside, the 1.21, which tended to provide some resistance yesterday, yet seems to have been turned into support right now. Even lower than that would be the 1.1990, which provided support at the early days of May. Even lower, the 1.1905, which served as a resistance and a support level in the beginning of April. To the upside, I would note the 1.2175, which forms the highest point of our chart. Even higher, the 1.2275, and the highest level noted would be the 1.2350. Now moving to Euro's fundamentals, the common currency seems about to end the week lower against the USD. It should be noted that Euro's fundamentals continue to be surrounded by the path of the pandemic. On the positive side, we must note that the area's vaccination efforts seem to be picking up pace. It's characteristic that Germany is reported to have set a new daily record in vaccinations with 1.35 million doses administered yesterday. The EU seems to avoid the AstraZeneca vaccine and intensifies its efforts with Pfizer. Also, on the positive side of news is that the number of new daily cases seems to be peaking at lower and lower levels, both for France as well as Germany, the two largest economies of the area, which may enhance the economic outlook for the zone. On the monetary front, we would highlight ECB President Lagarde's speech on Thursday among a number of ECB officials, with scheduled appearances scattered throughout the week. As for financial releases, we note on Tuesday Eurozone's estimate GDP rate for Q1, and on Wednesday the final HICP rate for April. On Friday, we highlight the release of the zone's preliminary PMI figures for May, with special emphasis being placed on Germany's manufacturing sector and France's services sector, with Eurozone's composite PMI reading providing a more general view of economic activity in the area as a whole. Moving now to the Aussie. This is AUD-USD's 4-hour chart. Note how the pair has rather stabilized in the past 2 days around the 0.7725 currently support line. Important levels to note would be to the downside, as we have mentioned, the 0.7725. Even lower than that would be the 0.7665, which served as a resistance line back at the early days of April. That would be around the 7th and 8th of April. Now it's turned into support. Even lower than that, we note the 0.7595, which served the pair rather well, as it was tested on the 9th of April and the 14th of April. To the upside, we would highlight the 0.7785, which provided resistance once, twice, 3 times. Even higher than that would be the 0.7850, which also provided some resistance. While skipping the high point, we move directly to the 0.7945 resistance line as the ultimate bullish scenario. Now moving to the Aussie's fundamentals, AUD also weakened against the USD during the week and is about to end the week lower. It should be noted that RBA's dovish stance tended to highlight the possibility of interest rate differentials widening, given that inflation in Australia is expected to remain below RBA's 2 to 3% target for some time. In the coming week, we expect AUD traders to focus on the release of the Australian employment data for April on Thursday. Prior to that, though, on Wednesday, we would also note the wage price index release for Q1, while on Friday we get the preliminary PMI readings for April. However, it's not only Australian data which are of interest for Aussie traders. From China, we get on Monday's Asian session the industrial output growth rate, which is of great interest for Australian exporters of raw materials, as well as the retail sales growth rate for the same month. Now, overall, we maintain the view that fundamentals will continue to affect the Aussie in the coming week as well. It should be noted that iron ore prices weakened yesterday after China practically sounded the alarms about where the industrial metals price is heading to, thus increasing worries for the demand side of one of Australia's main export products. Also, an escalation in the US-Sino relationships could have an adverse effect on the AUD, given that China is one of the main export destinations for Australian raw materials. Now, on the monetary front, we highlight on Tuesday the release of the minutes of RBA's last meeting. And should the document reaffirm the dovish stance of the bank, we may see AUD weakening. Now, moving to the Canadian dollar. And this is USD CADs for our chart. Note how today the pair's price action has broken the downward trend line, guiding the pair practically since, I would dare to say, the 28th of April. Some analysts even highlight this downward movement even further back. Thus, we are tended to switch our bearish outlook in favor of a sideways bias. Now, important levels to note would be to the downside, the 1.2060, which notes practically also the lowest point of the pair's price action, which provided considerable resistance, reversing the bearish movement on the 12th of May. Even lower than that, we note the 1.1995, and even lower than that would be the 1.1920. Note that these levels can be found practically 3.5 years back. That's how low actually the pair has been trading. Note, however, also today how the pair broke its upward motion as it more or less reached the upper boundary of the levels marking it. To the upside, we note the 1.2140, even higher the 1.2230, and the highest level would be the 1.2315, which marked the resistance line back on the 4th of May. Once again, we would highlight the Bollinger Bands, which tended to provide reversal points. Moving now to the fundamentals of the Canadian dollar. CAD strengthening against the USD, as we have mentioned, seems about to hit a halt after 5 consecutive weeks as the pair stabilized somewhat. The stronger than expected US CPI rates tended to contribute to that effect. Yet also BOC Governor McClem's statements yesterday tended to be quite worrying. The governor in his speech on Thursday stated that should the CAD continue to gain substantially, it could impact how the bank sets its policy, which more or less raised the flag also for Canada's exports. On the other hand, the bank's rather confident, if not hawkish view, was reasserted as he stated that the QE program could widen the wealth inequality while increasing asset values, while high inflation is harder on the low income part of the population. As for oil prices, which is one of Canada's main export products, despite some weakening during the week, they tend to remain at rather high levels. The weakening derived mostly from the restart of operations of a US pipeline that was hacked, implying greater supply, while on the demand side, worries for India's coronavirus situation tends to increase worries. As for financial releases, next week we highlight on Wednesday the CPI rates for April, which tend to gain on importance also due to BOC Governor McClem's statements, while on Friday we get Canada's retail sales growth rate for March. That should sum it up for the week. However, before we let you go, a small general comment. Now, overall in the FX market, given the wide dispersion of financial releases, we expect the USD to relent some of the initiative to other currencies, yet overall probably to remain the king. We would also highlight that different fundamentals could affect local currencies, yet the US fundamentals may preserve the ripple effects globally. Now, besides the FX market, we also note the weakening of the US equities markets, as indicated by all 3 US major indices, being the Dow Jones, the S&P 500, and NASDAQ. while we note that Friday's US session is still ongoing. As for gold, it's characteristic how its prices are about to end the week pretty near to the levels it started on Monday. Overall, though, we continue to highlight the adverse relationship of gold prices with the US dollar, as well as the possible effect of the US yields on the shiny metals price action. That should be it from all of us here at IronFX. Best wishes for solid trading.